Hello, beloved. This is Christophe with Financial Wisdom. My pursuit in the financial industry has been wealth creation or achieving financial independence. Basically, ensuring that money is working for you for the rest of your life and not you working for money. And the first lesson when it comes to financial independence or wealth creation is the fact that it is impossible to create wealth or achieve financial independence by relying on your own money. You need other people's money in the form of credit or loans. This teaching is about portfolio loans or no credit required portfolio loans. Portfolio loans are loans that are secured by your portfolio or investment account. There are two types of portfolio loans. We have credit-based portfolio loans and non-credit-based portfolio loans. For example, when you take a loan from your house, credit is required, so it falls under credit-based portfolio loans. However, when you take money from your 401k account, they don't require credit, and that falls under what we call no credit required portfolio loans. In this teaching, I'm going to examine three different non-credit based portfolio loans available to all of us that each and everyone can take advantage of. By the way, if you like what we are doing to help our community, kindly subscribe to our channel and share with friends and families.
We all know about 401k loans, but unfortunately, a lot of us don't have much information about other non-credit based portfolio loans, such as margin loans, leverage loans. So the purpose of this teaching is to go over these three types of non-credit based portfolio loans that we all can take advantage of. I will emphasize more about the leverage loan because that is one of the loans that most of us have no idea of. To me, it is the best of all, is the best among the three. At the end of this teaching, you will agree with me or you understand why the leverage loan through the IUL is actually the best when it comes to using portfolio loans to create wealth. By the way, IUL stands for Index Universal Life. It is a permanent life insurance that has cash value or investment component built in it. And the money that will grow in the policy, you can either take it out as cash or you can take it out as a leverage loan. You are going to look at key areas. Number one, the source of the loan. Where does the money come from? Well, on the sponsored loan or 401k TSP, the loan is taken directly from your account. So whatever balance that you have, that is where the money is pulled from. That is why anytime you take a loan from your 401k account, the balance goes down because the money is taken directly from the account. On the margin loan through stocks, the loan is taken against your account. Whatever balance that you have, they take the loan, they use it as a collateral to give you the loan that you need based on a certain percentage. Now, IUL, the money that you are taking is not from your account. The loan is pulled directly from the company's account. So your account remains intact and will keep on growing. Now, let's look at a typical example. Let's say you have $70,000 in your investment account and you take out $50,000 from that account. $70,000 in your account, the value of your investment is $70,000 and you take out $50,000. Now, let's look at these three loans, how it will happen. If the account is a 401k or TSP, that you pull the $50,000 from out of the $70,000, well, it will drop from $70,000 to $20,000. Why? Because the loan is pulled directly from your account. That is why the balance dropped from $70,000 to $20,000. Now, on the margin loan or stocks, the $50,000 that you take out, it will be left with a net balance of $20,000. When it comes to IUL leverage loan, your $70,000 remains intact. You will get a $50,000 that you want, but you will still have your balance of $70,000. Why? Because that $50,000 loan that you requested would come directly from the company's general account. Number three, how much maximum loan can you get? On the 401k TSP, you can get 50% up to $50,000 of account balance. You won't be able to take more than $50,000 or 50% of your account. Now, when it comes to margin loan on the stocks, you can also get up to 50% of your account balance. Now, leverage loan, this is where the difference comes in. On the IUL leverage loan, you can get up to 95% of your account balance. If you go back using the $70,000 scenario, you'll be able to get 95% of the $70,000 that you have. Now, let's look at the IUL on the leverage loan, where you see the major difference. Under the leverage loan through IUL, you can get up to 95% of your account balance. That is, the company will give their own money to you up to 95% of your account balance. Now, let's look at the next one. How many years do you have to pay the money back? On the 401k TSP, you have 5 years that you must pay back the loan. On the margin loans or stocks, there is technically no due date. You can use the money for as long as you want. On the leverage loan, IUL, there is also no due date. You can use it throughout your entire life. You can use it until you die. You don't have to worry about when to pay, how it is due. You don't have to worry about that. Again and again, this becomes a plus when you compare it to 401k. Would you rather take a loan where you have 5 years to pay it back, or you will consider taking a loan that there is no due date? The obvious answer is the loan with no due date. Now, what about if you don't pay the loan? What happens? On the 401k, if you don't pay the loan at all, it becomes forced withdrawal. You pay taxes, you pay penalties. On the margin loan stocks, if you take out the loan and the market falls, you will be presented with a margin call. And if you don't pay the margin call, they will sell your assets. When it comes to IUL leverage loan, again, in the first place, there's no due date. So you can use the loan until you die. All right, now, if you don't pay, what happens? Again and again, the only time that they will ask about the money is during settlement. For example, God forbid, you pass. Now they have to settle the account with your beneficiaries. Then the loan will be taken out from the account balance of your investment, and they will add the rest to the life insurance and give it to the family. Or let's say you close the account. Once you close the account, they will have to settle the differences, and that is where they will pull the loan that you have taken from the account. In a nutshell, when it comes to leverage loan under the IUL, you can use the money in your lifetime. You can use it for as long as you want, do whatever that you want to do. There is no pressure, no letter on pay this loan, they pay this amount on this date and that. Now again, ask yourself, which one will serve you good? With this 401k loan, stocks loan, leverage loan, IUL, again, ask yourself, with these 3 types of loans, which one will help you? Is it the sponsored loan through 401k TSP, margin loans through stocks, or leverage loan through IUL? You have seen the difference. By the way, this is not to say that forget about stocks, 401k, and only concentrate on IUL. No. I personally, I have stocks, and I've also taken money from my 401k, and of course, I do have the IUL. So my encouragement is that get all the 3. Get all the 3. Then when you are taking out a loan, you use the one that has the best benefit, the best favorability. That is my encouragement. In my next video, I will go into a little more deeper about the leverage loan and how you can use it to buy your house or pay off your mortgage or to pay off your car loan, student loan, any bill in your life, or to use the money to start a business. If you like what you're doing to help our community, please subscribe to our channel and share with friends and families. God bless you.